If you've ever turned on the financial news, I bet you've heard the terms bulls and bears. They're literally everywhere. But what do they actually mean? Well, today we're going to decode the market's most famous animals.
So yeah, why does the world of high finance sound like it should be in a zoo? It's a great question. And you know what? The answer is a lot simpler and way more memorable than you probably think. So where do these names even come from? I promise it's not some complicated financial formula. Nope, it's all about how these two animals attack.
It really all boils down to this one simple image. Think about it. A bull fights by thrusting its horns up into the air. That powerful upward motion, it's the perfect symbol for a rising market. And on the flip side, you've got the bear, which attacks by swiping its massive paws down. It's the ideal metaphor for a falling market. Up versus down. See? Simple, right?
So, let's start with the bull market. Officially, it's when prices are on a steady climb. But honestly, it's more than just numbers on a screen. It's a vibe. It's this feeling of optimism and confidence, this widespread belief that the good times are here and they're just going to keep on rolling.
And then you have the bear market. As you can probably guess, it's the polar opposite. Prices start to drop. The whole mood just gets darker. Pessimism and fear start to creep in, and all that bullish confidence, it just completely vanishes.
But what's really interesting is that a bull market isn't just one long, steady climb to the top. It actually unfolds kind of like a classic 3-act story. So let's break down those phases.
Okay, so it starts with accumulation. That's when the smart money quietly gets in. Then comes public participation, which is when pretty much everyone else starts to notice the party. And it usually ends with a bang, euphoria and speculation. And that's when things can get a little crazy.
So, phase 1, accumulation. This one's kind of sneaky. It often starts when things look their absolute worst, like right after a downturn, when most people are still totally scared. This is when the really savvy investors, the smart money, they see an opportunity. They quietly start buying up assets they think are basically on sale, laying the foundation for the climb that's about to come. Then we hit phase 2. And at this point, the secret is out. The general public starts to catch on. You see good news everywhere. The economy is picking up, companies are doing well, and that upward trend is just impossible to ignore. This brings in more and more investors, and the bull run really starts to gain some serious speed.
And this quote, wow, it just perfectly captures that final phase. This is the absolute peak. It's total euphoria. The market is all anyone can talk about. You have people who have never invested a dime jumping in because they're terrified of missing out. And at this stage, prices can get completely disconnected from their real value, driven by nothing but hype and this belief that the market is just going to go up forever.
But as we all know, what goes up, well, it can also come down. After that euphoric peak of the bull run, the mood can shift, and sometimes it shifts really, really fast. The bear wakes up. So when does a little downturn officially become a full-blown bear market? While that bad feeling is a huge part of it, there's usually one specific number that analysts are watching for, a drop of 20%.
And there it is. This is the definition you'll hear everywhere. A bear market kicks off when a major index falls 20% or more from its recent high. And that number is almost always connected to that widespread pessimism and fear we were just talking about. The two go hand in hand.
So what does a bear market feel like? It's that feeling of fear in the air. You see these sharp, sudden drops in prices, and importantly, this isn't just a stock market thing. It's often a big red flag for a weak or slowing economy, and it can even be tied directly to a recession, which is when things like job security start to feel like a very real concern for everyone.
Okay, so we've met the bull and we've met the bear. Now, let's put them head-to-head for a clear final showdown.
This table just lays it all out so perfectly. Look at that. It's like a perfect mirror image of itself. In a bull market, you have rising prices, optimism, and economic growth all feeding off each other. But in a bear market, falling prices, fear, and a slowing economy create this exact opposite cycle. It's just a really powerful demonstration of how numbers and human psychology are completely intertwined.
Okay, so this is all really interesting, but why does understanding the difference between a bull and a bear actually matter to you in your day-to-day life?
Because these are not just abstract terms for Wall Street traders. These cycles have a real impact on things like the value of your retirement account, job security in whatever industry you're in, and just the overall economic vibe.
Understanding the pattern helps you make sense of the news and all the forces that are shaping the economy that we all live in.
And here is the most crucial takeaway of all. Knowing this stuff isn't about getting a crystal ball to predict exactly what the market's going to do tomorrow. It's about having a better framework to understand what's happening today and why everyone is feeling the way they do. It's about context, not about trying to be a fortune teller.
So I'll leave you with one final question. Based on everything we've just covered, the headlines you're seeing, the state of the economy, the general mood you feel around you, which animal do you think is in charge right now? Is it the bull or is it the bear? Thanks so much for tuning in for this explainer.